What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Rory Johnson. Rory is a widely quoted researcher and expert in global commodities markets, whose work includes a variety of research and investment projects. This episode is a preview of the type of content that subscribers to our new Genius tier will have access to on a regular basis, including live quarterly calls with guests and researchers whose work I rely on to help me navigate markets and make educated investment decisions for my own portfolio. The tier is scheduled to launch later this month and will include, among other things, a first-class community purpose-built for real-time quality interaction, video recaps by me provided after every episode, priority access to in-person events, and regular Q&A calls where subscribers will be able to interact with and ask questions of my guests in real time. I am so happy to be launching this new tier. It's been so long in the making, and I feel so good about how much value it's going to deliver for those of you who choose to become subscribers to it. Rest assured, I will make a formal announcement on the podcast when this new tier goes live. And if you want to learn a bit more about it in the meanwhile, Rory and I spent a little time at the top of the podcast today discussing it before getting into his latest research on the state of the oil complex and what he's seeing in terms of supply-demand dynamics and market positioning. Since some of this episode deals with investing, it should be absolutely clear that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this special conversation with my guest, Rory Johnson. Rory Johnson, welcome back on Hidden Forces.
Thanks for having me back, Demetri.
So I want to give our audience a very brief overview of what they can expect, not just from today's conversation, but going forward between the two of us, as well as between me and a number of other guests who, like you, have appeared on this podcast before and who do amazing work putting out regular research reports and analysis on the economy and on money and markets that have become a core part of my own investment research that I rely on to help me think through investment opportunities and put many of the more conceptual conversations that I have on this podcast into practice. All of these conversations, as you know, are going to be part of a new subscription tier that we'll be launching in the coming weeks, which will include live Q&A sessions with the audience and a community platform purpose-built to maximize quality interactions, something that I continue to feel is lacking in the media today, and which I put a lot of thought into how I wanted to address and how we went about creating our community. Before I hand the mic over to you, Rory, I also want to tell listeners specifically why I've singled out folks like you to do these types of calls with. And the reasons are really selfish. You know, I want your time and I want you to walk me through your data decks because they're incredibly rich and comprehensive and full of valuable information. And oftentimes when I'm going through one of your monthly reports, I just want to pick up the phone and just ask you to explain it to me. But, you know, I can't ask you to take an hour, 2 hours of your time every month to private tutor me. As much as I'd like to do that, I can't do that. You're not my private tutor. And this is a common experience for me with a number of the people whose work I really rely on a regular basis. And so I thought to myself, how can I structure this so that it would be a win for me, a win for Rory, and a win for my audience? And so this is how all of this came about. It's an incredible value add for me. It's an incredible value add for my audience and for this new subscription tier that we're launching, for them to be able to get regular access to you and to ask you questions. And I think it's a really great opportunity for you to be able to speak regularly to my listeners, who I think are a really valuable audience to reach. So I just wanted to lay that out at the very top. But what are you doing with your subscription? And tell our audience a little bit about what your long-term vision is for Commodity Context.
Yeah, so thank you so much for the very, very generous introduction, first of all, Demetri. And I'm really, really glad you're getting a lot of value from the commodity context research. The vision I have for it is essentially just kind of my, a view and true kind of, true to the name of commodity context. My goal is to provide a factual, replicable, kind of repeatable exploration of the same kind of components and drivers of the oil market over time that I find so often just become kind of tacked on to whatever pre-existing thesis you have about the market. Bears will only mention calendar spreads when they're going down, or bulls vice versa. And I think, a holistic view of the market, this is an extraordinarily complex, massive market, most important commodity market on the planet, driver of a whole bunch of kind of sub-industries, obviously massively important with the inflation, issues we're having today. And I think it's really, really important to kind of understand all of those critical pieces, both on the kind of supply-demand fundamental side, the inventory patterns, policy shifts, and kind of market indicators like the forward curve and the futures curve, et cetera. And I think all of those things, they're very, very niche for people that don't look at this market regularly. And my hope is just to kind of demystify some of those common jargony points. And the idea is so we have, thematic research. So my last piece was on kind of a decomposition of Mexico's upstream supply. And that was the last piece of kind of a series I was doing on Canada, United States, and Mexico's upstream or production assets of oil for the launch of, I just recently released the North American Oil Data Deck, which joins the global data deck as two kind of pieces that are updated every month and bring together all of the research that I'm doing so that if you see a piece that I've written and you're like, that's a really interesting story, what happened next? I find so often you'll find a report, you're like, I'd love to know what happened, a year later or even a couple months later. The goal is to just have those charts and those exhibits constantly updated and kind of ready for you in your inbox every month at the end of the month. I'm also planning on launching a weekly kind of wrap up, more commentary, a little bit less formal, but just something that, there are so many things that are happening in the market, particularly right now, every week, that I can't touch on because they're not part of one of those thematics or something I've already dealt with. So I want a place to kind of deal with those as well. And finally, more and more of kind of this audio and visual content. And I think, as you mentioned, you'll be providing this to, this premium tier of Hidden Forces subscribers, and Commodity Context premium subscribers will also be getting a copy of this kind of interview, whether it's, I think standard every quarter, kind of a check-in. And then I think more broadly, we'll jump on and kind of talk about things maybe on a monthly basis if news flow and kind of market action kind of warrants, which I would say in this current environment seems more likely than not at the gate, at least. So I'm really looking forward to this, going forward with this relationship and kind of really bringing a lot of value to everyone that wants to kind of better understand and demystify the oil market.
Totally. And actually, I look forward to doing that as well, right? Because again, this is the other thing. I want to be able to give you a call. Like, Rory, help me understand what's going on here. Give me a deeper appreciation of some of these moves and how much of this is supply driven, how much of this is demand driven. How does this factor back into what you've been writing for so long? And having this relationship allows me to do that in a way that adds, again, value for you and value for me. And I cannot emphasize enough that because of the complexity of this business, and we're just talking about oil here, I think you're going to be expanding this, and you're going to be putting out more than just oil reports. But even just for oil, it's so complex. You can't hope to possibly understand this market. Well, I guess never, but fully. But you can never really hope to understand it by doing just one episode. And that was something I appreciated from our last conversation, which was I learned so much. And here I was, and I was like, I feel like I know nothing. And so doing this on a regular basis, I think also really will help people become educated. This is a long-term process, and it's no substitute for subscribing to your reports. And I do want to say that because one of the purposes of doing this is so that you can get exposure to this incredible research that you do. And I think people will naturally become subscribers to your material because they're going to want to see all of these reports and understand the stuff that we're talking about. So before we get into the latest global data deck report, as well as what you've done for the US, and maybe even discuss your recent piece on Mexico or some of the previous pieces on the US and on Canada, my last question is, well, maybe a couple of questions wrapped into one. One is, who are these reports for? Mm-hmm. And you kind of touched on this earlier, but maybe you can be more explicit about it. Who are these reports for, and what would success look like for you? Not from a financial standpoint, from the standpoint of what you're hoping that people get out of this. How do you want to touch people's lives in this way? Not to sound overly, overly woo-woo, but you know what I mean.
Yeah, exactly. So for your first question, who are these reports for? I would say my current subscribers are a mix of, your traditional kind of financial actors, portfolio managers, analysts, etc. But I think my goal really, and I think this ties into what the success of it is as well, is in this industry, there's a lot of really, really superficial kind of almost touristy commentary, regular news, things that kind of, you'll read something and it's kind of brought completely out of context and you're like, oh, that's interesting. But you don't really have a way of kind of putting it into your mental model because you really don't have a mental model, or most people don't have a mental model of the oil market going in. So the goal is to provide enough kind of real value-added deep research that deep sector experts can get something from commodity context and also hopefully be an enjoyable read. The other thing is a lot of the technical stuff is very heavy in this space. But I also want to present it in such a way that people that don't follow the oil market every day, people that are, whether they are kind of general investors, kind of macro focus, or even on the policy side, I really hope to be able to provide readers and listeners with basically a scaffolding, a spine of understanding of the oil market upon which they can then kind of read the news and kind of follow the market. And you can say, oh, okay, this happened, this supply piece happened, or this demand piece, or the curve is flattening. What does that mean? And I want to kind of give people the skills and understanding and kind of sense of the market that they can kind of do their own thinking, when they see something come along. So you don't always need to kind of go and say, what's Rory thinking about this? I want to give you the ability to kind of process this information on your own. So kind of build up your oil market focused toolkit, if you will.
I love it. I love it. So let's get into the reports. High level, what is the key takeaway from this latest report that you've put together, and how recent is the data that you're relying on or that we're looking at in this report?
Yeah.
Let's talk about, for example, we can actually think of both reports together if you want. Yeah. I'm thinking the global oil data deck, but the US one goes, or the North America one, which actually it's more like the NAFTA one, right? Because it's North America. It's really Canada, the US, and Mexico.
Correct.
And those go into more detail. So what does the latest data tell us, and what's the key takeaway?
Yeah, so to your point, one of the unfortunate things with all kind of sector research, and particularly the oil market, is a lot of this data is relatively lagged. So, people will have higher frequency estimates, but they're always kind of back updated to the latest kind of official data, which in this case for the August data deck was in June. So that was the kind of month of reference that we're dealing with. But I think, one, the oil market is reasonably slow moving on the fundamental side. So first thing is, knowing where things were even 2 months ago puts you in a much better position to kind of sort out some of the BS that people are talking about and just kind of give you a sense of like, okay, this is where we were standing. We've likely changed somewhat and we can tell based on how the market shifted, but that's where we were then. I think that's an important kind of concrete starting point. And what that tells us is essentially, since the beginning of the pandemic, basically we had this massive oversupply. And then for basically ever since the second half of 2020, we've been chronically undersupplied in the market, which, that explains this kind of rip-roaring rally we've had. It explains the fact that inventories went from all-time highs, down back to 2010 levels in record time. This was a very, very fast-moving market during that period. And that basically held right up until the beginning of this year. And then early Q1-ish, but definitely into Q2 of this year, supply has been slowing down, which is something that we've expected, right? Particularly with OPEC Plus, coming up to the end of its planned return of barrels, and particularly with all of the various parties, particularly Nigeria and Angola, kind of falling short of their committed kind of production kind of expansion. So that's been slowing off, which is something that we've expected. What we didn't expect to the same degree is the fact that demand has turned very, very strongly south for basically the last quarter in particular. Now, a lot of that's been driven by China, but I think more broadly, kind of globally, we have seen demand conditions ease. And I think that dovetails, reasonably kind of sensibly with this idea of a slowing economy, recessionary fears, et cetera. But I think the important thing is that if the oil market was loosening, and we know that the oil market is loosened. If that loosening was because of, let's say, a resumption of the voracious pace of growth that we saw from the US shale patch, that becomes a kind of a chronic concern that can demand ever kind of grow back to reach that pace of supply growth. But that's not what we're seeing here. In fact, we actually are seeing supply continue to slow in kind of its growth globally. But what we also saw was that demand turned south. So unless we have a completely kind of deleterious recession verging on depression and this, demand slump continues, absent that reality, which I still don't think is most people's general base cases. I'm sure some people, but I think overall the market's not expecting kind of a deep lasting recession. That demand will bounce back. And I think the demand is always going to be a bit more volatile than supply just because of this kind of churn of the economy and everything else. But I do think that as that demand comes back, then you kind of run back into the supply issue. The other issue, and I think the main theme, if you will, of this year, which helped drive oil prices to, $140 Brent briefly at the beginning of March, was the fear and concern of an acute loss of Russian barrels. Back in March, the IEA was saying that we could expect upwards of 3 million barrels of Russian supply loss, which would have put the market deeply into deficit. The market reacted to front run that. And then what ended up happening was we didn't lose those barrels, definitely not as quickly as we thought we would. So you've seen much more of a pivot from European shipments and North American shipments towards Asian shipments, China, and the largest incremental grower is India. So, supply has not fallen back on the Russia story as much as we've expected. Now, prior to the invasion, the general assumption was that Russian supply was going to grow. So relative to that base case, we are still negative Russian supply, but it's basically been more or less trending flat-ish for the last couple of months, which we will see if that continues. I still think the risks to Russian supply are on a weighted basis to the downside as we progress to the end of the year and as sanctions continue to tighten. But I think that remains a major wild card. And I think part of why the oil price is so volatile this year is that, and I think we talked about this on the last podcast, is that every major supply demand variable that we track, the error bands are really, really wide around them. We don't know if Russia is going to be producing, 10 million, 9 million, 7 million barrels a day as of this time next year. We don't know how much, U.S. supply and the shale patch is going to accelerate because that's still a major unknown. And there's, now these questions of is OPEC going to cut now? So I think all of these major factors give actually a fundamental justification to the volatility that I think a lot of people just kind of, slough off as kind of speculative kind of fervor. But I think it is actually pretty justified given the widely varying fundamentals we see in the market right now.
Right. And that's reflected in the volatility of the oil price. I mean, commodities tend to be a more volatile asset class in general. So I'm curious, how much Russian oil was hitting the market right before the invasion of Ukraine, and where are we today?
Yeah, so just before the invasion of Ukraine, Russian production was, not exact, but ballpark kind of 10 million barrels a day. And that maintained itself for about a month, fell off by about 1 million barrels a day, give or take, in April as some of those initial self-sanctioning logistical bottlenecks kind of fed back into the Russian sector. But then, and I think that was when everyone was like, aha, it's here. The fall off is here. Now it's kind of a straight line down. And you actually did see various forecasts like the EIA kind of take that, fall off and then project it forward. But, what ended up actually happening was, Moscow found an outlet for those barrels that had been falling off and rerouted them largely to mainly India, but also, increasingly to China. So that allowed production to bounce back. And we are, I don't think we're quite back based on the latest data to pre-invasion levels, but we're pretty close. And and Russia has actually closed the majority of that gap that they had lost on the production side.
So before we got to this part of the conversation, when we were talking about supply and demand, you said that unless there's a very deep and long-lasting recession, you would expect price to bounce back. Flesh that out with detail for me. Mm-hmm. What do you mean when you talk about the price bouncing back? How range-bound is this in your mind? And the other question is, when we're talking about a deep and lasting recession versus one that isn't, what are we talking about? What do you mean? Like, what kind of an economic slump will be required to move oil prices beyond a certain range again? Because in my mind, I kind of think of it as anything below $80, you have something pretty serious. But that's pretty much the extent of my forecasting. So how do you think about this?
Yeah, so I think there's a couple things. So if we return to kind of, again, if we're talking about the core kind of framework and the scaffolding of this market, I think the first thing you look at is the calendar spreads or the kind of steepness of the futures curve. Backwardation or a premium of prompt prices, which means the curve is downward sloping into the future, is a bullish sign because it reflects tightness in spot markets and basically is incentivizing a drawdown of inventories. We're still in a backwardated market, although not nearly as backwardated as we were at the beginning of June. But that, I think, is the sign that markets still remain reasonably tight. Inventories remain very, very low on a global basis. They're back down to around that kind of 2010 to 2014 period when prices were very high, kind of, structurally above $100 a barrel. So in terms of how I think about, let's say, for instance, that demand rip-roared back and next year we were on average 1 million barrels a day oversupplied. Let's just throw it out as an example for how I think about this. Essentially, what that would do is that would put the market more steeply than now back into backwardation and would likely continue to draw down commercial inventories globally. That would continue to push prices higher and higher and higher. And I think in terms of your question about range boundness, I think the question is how long that period of undersupply persists. Because again, it's always a function of the spot market tightness, the inventory position, and the kind of length of that reality. So I think what you do is the front of the curve would pop higher, and the longer it was tight and the lower inventories went, that price would drift higher and higher and higher, getting dragged kind of up by the front of the curve. And that's kind of how I see it going down. Sorry, what was the other question at the beginning?
Well, but let me...
the lastingness of the recession and kind of how that would drive things. I think the main thing is, so in most global economic slowdowns, what you see in oil demand isn't typically an actual outright contraction. Typically, what you see is a slowdown of demand. So let's say demand was going to grow by 1.5 million barrels a day this year. Maybe that's only 1 million. Maybe that's only 500,000 barrels a day. And that is, again, going to be a function of how long that lasts, because it would, the weakness would typically be concentrated in a particular set of quarters or whatever. So the longer that lasts, really what it would do is, let's say the recession was reasonably severe and lasted a full year. What that would do, in my mental model at least, is it, rather than pulling down demand on an outright basis, it basically holds it kind of flat. Things don't move very quickly on the demand side, and that gives the supply side an opportunity to kind of catch up and make up for lost time. I think that's the main function of how I think a recession would drive the fundamentals of the market, is kind of giving supply a chance to catch up. Whereas if we don't have that and we just see a bounce back of, Chinese demand from this rolling waves of lockdowns, and the rest, particularly of East Asia, kind of comes along for the ride up, mixed with kind of continued strength in US and maybe kind of a return of some kind of economic health in Europe, which is obviously a big challenge right now. But I think all that together, you would turn demand back up, and then it would likely outstrip supply on the other side again. Right now, we are, based on the June data, oversupplied in the market, but with a very low inventory position. So it's kind of we're not in a great position right now, but the broader kind of strategic context is still actually very tight and bullish. The other thing we haven't talked about to a certain degree is the effect of the Strategic Petroleum Reserve, which has added additional kind of supply to this market at a time, frankly, when we're already, by my numbers, oversupplied. Now, when that decision was initially made by the Biden administration to release, a record level of crude, about 1 million barrels a day just from the US alone, from the SPR, markets were signaling extreme tightness. We had very, very high prices. I think at the time, WTI was 120 or above. I think when they initially started thinking about it, you're talking about, even higher at the beginning of the crisis. The unfortunate thing is that, as we mentioned, earlier, we didn't actually lose all of the Russian supply we thought we would. So now we're actually in an overall, looser, probably right now slightly oversupplied market. And then add to that 1 million plus barrels of SPR. No wonder kind of all of the indicators we have in the market are that things are weakening. The curve is flattening. We're not there yet, but we were getting pretty close actually to flipping, at least temporarily, into contango conditions, just based on how much of that kind of oversupply in the spot market we were seeing. Now, that SPR release will end, towards the end of October into November. And then we kind of will see how tight the market is then. If you take out 1 million barrels a day, which is, ballpark about what, Indonesia or the UK offshore produces, that's a major supply source that we're going to lose at the end of October, just theoretically at the same time as OPEC will be stopping or have no more kind of spare capacity to add to the market with its current plan. So that is when I expect the market to kind of retighten again materially, again, absent kind of a calamitous kind of demand fall off.
So much to dig in there. Real quick. So when do you expect that to be, you said?
So kind of towards the end of October into November will be when the SPR kind of mostly looks like it's going to wrap up. There have been musings that if prices stay high, maybe they'll extend it. But I think these are still mostly musings at this point. I think we could more or less take the White House on its plan right now, which is 6 months, which would end in kind of late October or November.
Let's go back to price, though, again, because this for me is tough to wrap my head around. Oil prices were as high as about $120 a barrel. They got down to the near $80 recently. Mm-hmm. I don't understand how to think about or project forward oil prices based on my expectations around the demand picture, because I have been very bearish since 2021 without, being able to tell you exactly what demand would be. No one knows, but I'm definitely no expert. I could see what was going on in credit markets. I could see what was going on with inflation, and I felt that policy was going to align in the direction of reducing aggregate demand. So we clearly are seeing continued concerns about this, but how do you, to the best of your knowledge, I'm curious, without even putting you on the spot, how do you think about that in your head? What kind of, do you assign certain probabilities to price declines below certain levels? Where are we right? In your view, is $90 a pretty kind of relatively safe place to be when you're in oil if you were just rolling over the front end of the curve? How do you think about that?
Yeah, I think if things got worse, so if we had signs that, let's say there was a broader financial market rout, I think at the end of the day, crude is kind of, the foremost kind of risk asset. So I do think that in a complete risk off route in the market, oil is going to get trounced. And I think that is, there's always that kind of acute concern of kind of precipitous drawdown. Now, what we've seen historically is that typically those major drawdowns don't occur in crude in a backwardated market. When you look at the last kind of 3 big, and I did a piece on this called the arc of crude's curve. And I kind of looked at I explained how I assess and analyze the crude curve and how that kind of informs my view on the market. Because again, all the fundamental data is lagged. The crude curve theoretically is updating with information every day. So it's always going to be a very, very strong and kind of important source of information. So when you look at the last 3 major collapses in crude prices, namely kind of 2020 at the beginning of the pandemic, back in 2014 during the kind of initial onset of the kind of shale-driven collapse, and back in 2008 during the GFC, basically in the week to months before prices really collapsed, you saw the curve flip into contango, which is your kind of sign that the physical market was no longer really screaming that the market was tight at these levels. Now, every one of these major kind of pivot points is unique in its own way, et cetera, et cetera. But I think it's important that you have not seen a kind of a major collapse like that to what we would consider kind of painfully low levels for the sector without the market first signaling a physical oversupply through that contango channel. Now, there have been kind of 2 false positives. Basically earlier, 2018 was the last one where you did see the curve kind of briefly drop into contango and then bounce right back, and we didn't see a collapse. But again, I think it's, it's not a perfect signal, but I think of it as a risk regime kind of change signal. And I think that's why I was getting very concerned over this past week and into, particularly last week when the curve was really weakening, really flattening. You saw both prompt, which is the kind of first versus second month spread, as well as what I typically look at as a slower moving indicator, which is the year forward spread. Both of those were dropping towards zero, and it looked like they were heading towards negative levels. Now we bounced off of that, and I think it hasn't come to pass. But I would say that would be my number one signal for something concerning happening in the market, because once you lose that physical tightness kind of premium or bid in the market, then if you have a bearish narrative or a kind of a risk off route, there's nothing to really catch it on the downside. And I think that would be my major warning sign that something has really kind of come off the tracks and we're heading for at least a higher probability of a deep drawdown.
That is super useful to understand. And the more you talk, the more I think about other ideas for this new subscription tier or ways in which we can continue to add value through the community functionality and the platform. Because one of the things that I want to do for people, again, thinking about this as a continuing type of education, is provide them with additional information to help sort through a lot of the conversations that we have. Like, so many people, even if they've learned what contango and backwardation is, it's really hard. They keep forgetting what it is. They have a difficult time visualizing it. So maybe that's information that I can provide people as well, and we can include that in these kind of regular reports. So let's go back to SPR, because I have a quick question about SPR, and then I really want to ask you about the timely question of this price cap, which the G7 countries are talking about instituting. So a quick question I have about SPR is, and you've said this before, we've talked about it, which is that even though intuitively people think of SPR as a strategic petroleum reserve, as an inventory, it acts much more like supply. And in that sense, that kind of raises a second question that I want to ask you about, and feel free to kind of bundle these together, which is, why have we not been using this opportunity with the SPR release, or why hasn't the government used it to forward purchase oil? Why hasn't it done that? It seems that that would have been in its strategic best interest, because it's dampening price increases now in return for buying future oil at a lower price later. That's what you would expect a strategic player like the US to want to do. So what am I missing there? And why is it acting more like supply versus inventory? And why is that important?
Yeah, so I'll start with the kind of supply versus inventory story. And I have a piece in the hopper kind of coming down the pipe, writing on this at commoditycontext.com. But I think just to get out of the way, first and foremost, of course, there's major similarities between inventory and the Strategic Petroleum Reserve, right? They are both crude that had been produced and then got put into a tank or a salt cavern, a hole in the ground effectively, right? So in one sense, it is physically inventory or physical stocks of crude. But I think the important thing is when you're analyzing the market and when I'm building up these models, you have to think about how those differ in terms of their kind of function in the market. And the biggest driver here is that commercial inventories are going to be driven by, calendar spreads in the shape of the curve. Essentially, when the curve is in contango, so when the markets are oversupplied, when there's a discount on prompt pricing relative to the future, inventories build up, and they do that because it effectively creates an arbitrage opportunity. You buy crude at a discount, store it for a couple of months or a year, and then you kind of lock in that price and you kind of profit. That's how the market clears itself. Vice versa in backwardation, it creates an incentive to draw down, which is exactly what we saw basically from mid-2020 straight through to the beginning of this year. So that is how commercial inventories work. They provide a confirming signal for calendar spreads. They provide confirming signals for supply-demand balances globally, et cetera, et cetera. And all this happens passively. You have a bunch, of thousands, millions of atomistic actors in this market kind of doing all of this in a market-driven way. The Strategic Petroleum Reserve doesn't work like that at all. It will only draw down or build up on the order of, Congress, the president, particularly the president in this case. So the difference is that, in the market's perception, Biden releasing 1 million barrels a day from the SPR is essentially like a brand new oil producer pumping 1 million barrels a day just appeared in the market and is now essentially competing, sending barrels into the spot market, which is you've actually seen commercial inventories, particularly in the United States, kind of drift sideways on the crude side and a little bit up. Now, people will say, well, yeah, sure, but that's accounting for the massive drawdowns in the SPR. That's 100% correct. The SPR level is a valuable indicator because it gives you a sense of the time boundness of this producer, because you know exactly how much and how long this producer or the SPR can produce at that level. So it's obviously important, but I often see, and the reason I wrote this piece, one of my pet peeves is you see a lot of inventory charts. You see the seasonal inventory chart that goes up and it goes down over the year. And then you show this year, and when you include the SPR, it basically looks like it's falling off into a ravine, which looks really, really, really bullish. And I think it is on one level, but when you look at that relative to calendar spreads and the overall flat price, that line is pointing most steeply down just at the time that the market is weakening, which is very counterintuitive. And again, I think that's why it's really important to treat them as separate buckets, because otherwise I think it just kind of confuses analytically kind of what you're talking about and when you're talking about it. And then just to answer your question about why not forward purchase. So that's exactly. So I've actually written a couple pieces on this advocating essentially exactly for that. That this SPR should sell aggressively into very backward-dated markets like we've seen, but then immediately purchase forward and kind of guarantee that that's restocked both for strategic purposes, but also because if you want to send a supply signal to the market, because the risk with the SPR is that if you push prices down and then you kind of mute the industry response and the supply response you'd get from those high prices, you end up in a worse situation in the future with less SPR kind of crude in the tanks, if you will, and less capacity to battle it. So what you want is you want to both address the market tightness while actually enhancing the signal going to the supply side. But what you can do there is by selling to the front of the curve, spot market, you buy the future curve and you pull up the back of the curve, which is the price that these producers care more about. That's, I think, exactly how the SPR should be run. Mm-hmm. The reason they don't currently do that is the policy structure isn't set up to allow for kind of future purchases. But one of the things that I really liked about the Biden admin's plan to release the SPR is they've actually been listening, it seems, to some of these comments from the market, and they actually have instituted a rulemaking procedure, and they're actually looking at doing just that. So that rulemaking procedure is still happening, and it's coming. Government unfortunately works reasonably slower, even in times of crisis. But I actually think that that's the direction we're heading. So I'm very optimistic that we will see some of that in the future, even though it hasn't happened yet.
How do they refill the SPR?
So, I mean, you would buy, you would contract for future purchases.
I don't mean that. I don't mean that. I mean, just like, when do they decide to do it? Like, if it's not a thing that they're doing, if they're not replenishing barrel for barrel, how is that done? Just like, do you have a basic idea of how they do it?
Well, that's kind of the issue, right? Is we really haven't, the SPR now is down to a level that we haven't seen since the 80s. Obviously, things have changed substantially since then. We've never really filled the SPR like we did initially since, right? We've kind of filled it up and it's kind of just sat there.
When was that? When did we fill it up?
Through the late 70s into the 80s and into the 90s. And it's basically kind of sat there. You've had minor drawdowns for things like hurricanes and some conflicts, et cetera, but they've always been minor.
How much do you lose due to evaporation?
Not a lot, honestly. I mean, these things are, this works really, really well. They're all stored essentially in salt caverns or things that have already been depleted. So they're all down there. And crude is pretty stable like that. This is actually why you store it as crude and you don't store it as something like gasoline, which actually does have this issue that it's much less stable, much more volatile, and has a tendency to kind of evaporate or kind of build up pressure. So, there is that. And I think that's hopefully what we'll see going forward. And I think the main value of the asset of the SPR isn't always the crude inside of it. It's the capacity itself. Because now that we've sold, or now that we're going to sell down, 180 million barrels or something from the US SPR, that means you have 180 million barrels of spare space in those tanks. So when the market inevitably goes through its next down cycle, the SPR should be there to buy and basically help offset those price declines and smooth out the volatility in this market, which is really what we want.
Well, I mean, it's really fascinating when you think about it again from my perspective, a layman's perspective. You have not only a really great situation, which is where you have backwardation and the ability to sell into a market and then basically generate a profit, and on top of that, replenish barrel for barrel the oil that you had in reserve, but you also have this gigantic storage facility, effectively.
Yep.
So you have the ability to store, and you could push, to bring in your comment about the market positioning and the dynamics of the curve. You could have the capacity, theoretically, if this is your objective and you're fighting a war and you're trying to defund your opponent whose revenue streams depend dramatically or disproportionately on the production of key commodities like oil, you have the ability to potentially push this curve into contango and then generate momentum that further pushes prices down. And because you've got the inventory, you can then buy on the spot market and start pushing the price up. I mean, maybe that becomes a little, you end up thinking more like some kind of, I don't know, maybe that's a level of sophistication that we can't really expect policymakers to make. And maybe I'm oversimplifying it. Okay, so again, just in the interest of time, because while this is great and we've talked about a lot of really valuable things today, I also do want to say that my objective going forward is for us to keep these conversations on the shorter side. Yeah. And because we're going to be doing more and more, we're going to be able to really have relied on having had these sort of foundational conversations, and we'll be able to kind of update people on what's going on. So in the spirit of updating, talk to me a little bit about this price cap idea and how promising is this?
So I should say broadly that virtually everyone I know in the oil space, and based on my Twitter timeline, it's not popular. People don't love it. They think it's kind of silly and breaks how oil markets work. I'm a bit more sympathetic to it. I think that the idea is actually relatively creative. And I think we're in a moment of crisis where I think creativity like this is kind of both warranted and deeply refreshing. The challenge comes in the execution and the kind of political willpower to do this right. I think first thing we've seen is that the kind of people pushing it, and this has been a particularly favorite kind of policy project of Secretary Yellen, this has been moving glacially slow. We really need to be much further along this process in something so complicated. And just to kind of rewind very briefly, the idea that people are talking about is essentially, rather than putting a blanket ban on the purchase of Russian crude, like you've seen, let's say, with Venezuela or Iran, what you're essentially saying is, you're setting a price cap and you're only going to effectively sanction barrels above that level. But people can pay below that threshold and be fine. And the idea is you get the best of both worlds. You starve Moscow of war funding at the same time as you lessen the energy shock facing the world, particularly during this kind of energy crisis and inflationary crisis. So again, I think the impetus is in the right place. And I think I don't think it's a bad idea, but it's a complicated idea. And the reason is that it's hard enough, in the case of Iran, for example, it's hard enough to make sure that we know exactly where those barrels are going, who's buying them, to kind of sanction, et cetera, et cetera. And that's just literally, complete no-goes. Imagine if, on top of that, you then needed to conduct a forensic audit of the purchase to make sure that, the price was below this threshold and there wasn't any additional signs of backroom dealings and kind of circumventions, et cetera, et cetera. It's extremely, extremely onerous. And I think that has not been necessarily recognized by the proponents of the deal. And I think, we actually, just before jumping on this call, we actually got a communique out of the G7 talking broadly about their support for this, but it seems like they've really gotten almost nowhere on the specifics. And I think, again, the fact that we are now months into this process, and it seems like this is one of the favorite ways to deal with this crisis, that I think that's where the concern is it seems like Western policymakers are putting a lot of eggs in this price cap hope basket without actually seeming to understand the scale of the challenge and what they would need to do in order to make it effective. I mean, for instance, I haven't really seen that much discussion about what types of sanctions would be placed on people that actually paid more than the price cap. We've heard various points where people explicitly reject the idea that it would be secondary US, dollar sanctions like you have with Iran, but you would need some kind of sufficiently big stick in order to make sure people don't do it, particularly, again, during an energy crisis. There's a lot of incentive to secure barrels. The other thing is you really need to include countries like primarily India and China, but specifically India in this deal. Now, a lot of people will say, then it will never happen. But again, I think the important thing is to remember, in this deal, India actually also gets a benefit. Theoretically, they get the same crude and pay less for it. So, there is benefit there. But again, I think the proponents of this deal, and I would say I liked the deal, I liked the idea, and the longer it goes on like this, the more my optimism is slipping, just because it seems like there isn't a full appreciation for how complex and challenging the execution will be. That said, I don't think that it doesn't seem likely that it's going to make things worse. I think the main risk is that, and it could just make things better on the margin, slightly better if you want. But I think the concern is too many eggs being put in this basket, and doesn't seem like there's a ton of other ideas out there.
Yeah, that's fascinating. The other thing that I think about when you're talking, again, in terms of stitching together some of the more substantive commentaries and analyses that I would like to do, is bringing in the geopolitics, because India is in a uniquely weird position, which is they're in their own geostrategic competition with China. China has a very close relationship with Russia because Russia is basically becoming China's bitch in this relationship because of the fact that they've lost the European market, or they lost the long-term trust of the Europeans, and the Europeans are spending more on security. The U.S. has had a hard-on for Russia for quite some time, so that it's been pushing it into China's orbit. And so you can also see how the contours of this new global order, whatever it ends up becoming, slowly coming together. And there's an opportunity there for the Europeans, the Americans, to increasingly peel India off from the that eastern sort of geostrategic orbit, and maybe these are all kind of policy tools. It's interesting, in other words, to see how these individually structured deals and attempts to do different things will eventually, assuming just a basic level of competence and time, become part of a larger new geostrategic whole of government approach framework that looks much more like what we had during the Cold War than what we've had since. Last question, Rory. What should people be keeping their eye on now? Like, during the summer, a lot of what people were focused on, or earlier in the summer, was crack spreads. You heard that a lot about that. Mm-hmm. What are the big important things to be keeping an eye on if you want to have a more accurate forward sense of what's going to be happening, both on the price side and in terms of supply? Because again, we have some of these dislocations, so these two things don't necessarily correlate the way that they maybe would historically in a more free and transparent and normally functioning market.
Yeah, so I would say the number one thing on a volume basis that I think is going to drive the near-term, market is going to be, does China begin consuming more crude again? Does demand bounce back? Do you start to see a wind down of these rolling kind of draconian COVID-0 lockdowns? I just saw a story yesterday that it seems like we're seeing more of them again. I think, every time we think that they're going to be temporary or they're ending soon, it seems like they're extended. So I said that would be a big structural drag in the market. Prior to the lockdowns in February, I think the lockdown started in kind of March into April, but just in February, before those happened, Chinese demand by numbers actually reached an all-time high. And I think if you can get back to that level, we're talking about millions, I think, 3+ million barrels a day, more demand in the market, which is going to go a long way to kind of, in the near term, tightening conditions. So that's the kind of near term, this year into early next year question. On a structural longer term basis, it's going to be, can U.S. shale grow faster? Are you ever going to see faster U.S. shale growth again? We're going to see, it's still going to be the fastest grower in the market by a long shot. Million barrels a day plus every year, I think, is going to be standard. But we're far way off of seeing 2 million barrels of liquids production growth like we saw in 2018 before this kind of capital discipline and supply chain bottlenecks started to kind of really tighten the market. And then finally, in terms of the really, really near term, we're filming this on Friday, September 2nd. On Monday, there's an OPEC meeting. And, Saudi Arabia has talked about, they've talked about how there's a disconnect between physical and financial prices, and they might consider cutting back production after, 2+ years now of kind of easing supply back into the market. So I think that could go a long way towards tightening at least sentiment and kind of reestablishing, if you will, the kind of Saudi put in the oil market. But I think that's going to be interesting. It's going to be the first time in a while where there are kind of like legitimate directional questions about OPEC policy. So I think that's going to drive, the next couple of weeks. But I think, again, the two biggies are going to be Chinese demand, U.S. supply growth. And then I think, again, finally, just kind of going forward, seemingly forever now, is what's going to happen to Russian supply. Mm-hmm. Do we finally get to see some of those millions of barrels a day, 3 million barrels a day, like the IEA initially estimated? Does that happen through the end of this year into next as the EU sanctions in particular begin to bite? I think all of these are unknowns. I think I would have been far more certain of that a couple months ago, but obviously we've seen things slip and we've seen kind of, Russia persistently kind of outperform expectations on supply. So those would be the kind of, three biggies and then a kind of near-term OPEC spoiler and, potential as well.
This was great, man. I love this. I'm so excited to be doing these on a regular basis. You have no idea.
Me too.
It's going to make me so much smarter. And I know it's just going to be so valuable for everyone, for all of our subscribers. So last question, please remind people how they can follow you on Twitter and how they can subscribe to Commodity Context if they're interested in doing that.
Yeah, exactly. So my on Twitter, I'm at Rory_Johnston. And the Substack is commoditycontext.com or commoditycontext.substack.com. Both get you to the same place. So I look forward to kind of seeing more people.
Fantastic, Rory. Thank you so much.
Thanks so much, Demetri.
For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.